Has the thought of trading options piqued your interest of late? Do you not know where to start, or does it seem overly complex? Well, if that's the case, in today's video, I'm going to be discussing the very basics of options trading and how you can see if you would like to utilize this strategy for your portfolio. We will touch on calls versus puts, buying versus selling, and look at premiums and all the different terms at a beginner's level for you to get just the basic understanding of options trading. For me personally, I use options on a monthly and even weekly basis to earn income. I also use options to hedge against my portfolio with positions that I hold. And I also use options to create my very own buy the dip opportunity, all of which I will discuss here in this video and in future videos to come. So if you are interested in learning more about options at a beginner's level, then do me a huge favor and hit that like button, give me a big thumbs up, and let's get started with the video. Hey everyone, Mark Rusin here, back for another video. As always, everything discussed in this video is for educational and informational purposes only, as I am not a financial advisor, so please perform your due diligence before investing in any stock mentioned in this video. Also, if you're looking to open a new account, M1 Finance is running a special promotion for a limited time, to which you will receive $50 free if you open a new account and fund it within 2 weeks with $100. That's a 50% profit just for opening a new account. So go down to the link in the description below and grab your $50 free at M1 Finance. Also down there's a link to BlockFi where you can earn free Bitcoin for opening a new account for those of you looking to get into the crypto world. Okay, if you've seen many of my other videos, we talk about anything from dividend stocks to growth stocks to some of the top ETFs, but I've received plenty of messages either on social media or even here on YouTube for those of you looking for more information on options trading at a beginner's level, a very basic level, and then we'll build on that moving forward. So that's exactly what I'm going to do in this video today, is try and break it down so that you walk away having a better understanding of exactly what options are and at least some of the key terms to give you just a better, that strong foundation to start with. All right, let's start off from the beginning. What an option is. An option is an obligation or potential obligation, or otherwise known as a contract. Think of it as a contract. One option contract equals 100 shares of the underlying stock, which could be an individual stock or even an ETF. An option contract is between a buyer and a seller. It's much like individual stock trading. There's buyers on one side and sellers on the other. Pretty basic. When owning shares of a particular stock, say Apple in this case, if you own 100 shares of Apple, you own a piece of the business. However, if you own one option contract for Apple, you don't own any shares just because you own that contract. All the option contract does is control those shares, but you do not actually own a piece of the business. So now that we understand that one option contract equates to 100 shares, and we understand that options trade on a daily basis similar to individual stocks or ETFs. You have a buyer on one side and a seller on the other. Now let's discuss some of the key terms when it comes to options. The first term that we will discuss is the strike price. This is the agreed upon price when it comes to the contract. Both parties agree to either buy or sell the underlying asset, which is either going to be an individual stock or an ETF. They're either going to buy or sell at that particular price. So as an investor, you can bet that a stock will go above this particular strike price, or you can even bet that a stock will go, or ETF will go below this individual strike price. And there's ways to benefit or profit from both, which we will look at, the buying and selling side and calls versus puts here in a second. The second key term that we will talk about today is the expiration date. So when you're looking at an option chain, you're going to see the strike price in the middle, but you're also going to be looking at expiration date. So with shares, when you buy shares of Apple, there's no expiration date. You just own that company unless they go bankrupt or they get bought out. Now, the most valuable company in the world is not going to get bought out anytime soon or ever at all, but you get what I'm saying. There's no expiration date. But with options, there comes an expiration date, and this is where some of the risk is involved, because if your bet does not play out in time, it may play out later, but if it does not play in time by that expiration date, you could lose the money that you invested or bet on with that option contract. So options have an expiration date. The third term that we're going to talk about that relates to options when you're looking at an option chain, first we talked about the strike price, second we talked about the expiration date, and third we're going to talk about the premium, which is the cost of the option. Now with premium, remember there's buyers and sellers, just like stocks have buyers and sellers, options have buyers and sellers. If you are a seller of an option, then you get to collect the premium. If you're going to be the buyer of an option, then you are going to pay the premium. This is otherwise known as the cost to buy this potential obligation or this contract, this option contract. And we are going to look at a real life example right now. The further you go out in terms of the expiration dates, so expiration dates could expire on a weekly basis. You could have expirations that are on a monthly basis. They go out even multiple years. But the further you go out, which gives you more time for your bet to come through, the higher the premium. The lower the expiration, meaning if the expiration is this Friday or say next week, there's going to be a much lower premium that you're going to have to pay, or a premium that you could collect if you're writing the option contract, just because it's less likely that this trade is going to come to fruition per se. Okay, let's take a look at a real life example. I'm going to go and look at Apple as our example here, and I'm going to click on the option chain. So when you go to Apple, it's going to show you normal stock information where you can buy or sell your shares of Apple. But if you click on the option chain, this will take you to where all of the options that are available for Apple. All options are broken into calls or puts. You can buy a call or you can sell a call. You can buy a put or you can sell a put. More experienced traders, and as you understand options further, you could actually do a combination of some where maybe you're selling a call and buying a put, or just mixing these up to get, there's different trades called like butterflies or iron condor spreads. We're not going to go into that because remember, this is the basics video here. We're going to discuss that more in further videos, but today we're just trying to get our feet wet and lay that foundation to where we understand key terms and exactly what this options stuff is all about. So if you are bullish on a stock, and let's say we're going to keep using Apple here because we're looking at that example, one of the things that you could do with options trading is buy a call option. And remember, if you buy one call option, that equates to, that's right, 100 shares. So let's take a look here at the Apple option chain. What I've already done here is I've went and clicked on the January 28th expiration date. So you see in the shaded area up top, January 28th is our first option. So that's going to be the expiration date. My bet, whatever I do here, needs to happen by January 28th of 2022. So we're bullish on Apple, and we think Apple will surpass, let's say, $180 per share by the expiration date. If that's the case, then we could buy the $180 call option, which when we look at the option chain, we see a bid and ask price. This is the same as it goes for individual stocks. You're going to have bid and ask price. The bid price is someone looking to buy, and that's the highest bid at the moment for that call option. Same goes with individual stocks. You'll have the bid price will be the highest that a buyer is willing to pay for that particular stock right now. The ask price, on the other end, is the lowest that someone is willing to sell that option for at the moment. Or if you're on the individual stock side, the same goes for that. The ask price is the lowest that someone's willing to sell that individual stock for. So looking at our current call option, which we're looking at the $180 call option on January 28th, you're going to see we have a bid price of $5.60 and an ask price of $6.40. So nothing will take place until someone meets in the middle. So either the bid comes up a little bit or the ask come down. So let's say they meet in the middle somewhere around $6. This means you would need to pay $600 for this contract because if you recall, one option contract equates to 100 shares. So we need to take the option price times 100 shares, which is how we get to $600. So if you want to buy 2 option contracts for this Apple 180 call, then you're going to need to pay $1,200 for the option contract. As the buyer of the option contract, you are bullish on Apple and you want to see the Apple share price go above $180. Okay, so let's think about our terms again. So remember, strike price was first, which is the $180. Expiration date is the January 28th expiration date that we chose. We can really choose any of them. And the premium is the price we paid for the option contract, which was $6, but we need to times that by 100 because one option contract equates to 100 shares. So that equates to $600. Okay, so I've bought a call option now, Mark, but what does that mean? How do I make money? Oh, I am so glad that you asked that question. Let's take a look. Okay, let's look at the first scenario. Let's say the stock goes to $190 by your expiration date. What this means, since you were a buyer of the call option, that means you have the obligation, or you get to, the deal that you made was that you get to buy shares of Apple for $180. So if you bought one contract, that means you get to buy how many shares? That's right, 100 shares of Apple at $180, even though at expiration date, it's trading at $190. That means in terms of profit, you already have profited $10 per share times however many shares that you bought. So if you had one contract, 100 shares, there you go, that's $1,000 profit. Scenario 2, let's say the stock price stayed around 180 or even stayed below the $180 mark. Well, you're not going to exercise your option because if Apple shares are trading at, say, 175 at expiration, you don't want to buy 100 shares at $180. So this means your option contract expired worthless. So the money that you lost was the premium that you had paid for the option contract. Now there's a third way that you can also make money, and this is where the trading of options comes into play. Similar to just buying underlying shares of Apple, the stock price is going to fluctuate on a daily basis. The same goes for options. If we see big swings in the stock price, the underlying stock price of the option that you bought, you're also going to see these big swings in the options price, the premiums. So if you bought an option after the stock price had dropped down, most likely the option price or the premium is going to drop down as well. But follow that up the next day and we see a big pop in shares of Apple, we are going to most likely see a big pop in your call option and you could sell the call option. So let's say that you bought it for that $6 per option, which equates to $600, and the next day it's trading at $6.75 or $675, meaning if you sold it right there, boom, you would make a $75 profit. Now, of course, these are small, easy examples, but just wanted to lay that out there so that you understand that you can trade options and not have to wait entirely until expiration. Some people don't even wait a full minute. They're trading in and out of options all throughout the day. So buying a call option is you looking for the stock price to go above your strike price. But let's say you want to get out of this option. You don't want to wait till expiration like we just talked about. Well, the only way to get out of a call option that you bought is to do the opposite. So if you buy a call option, you now need to sell the same exact call option. You will buy to open it, and you can wait till expiration if you want to. But if you say, hey, I made a little bit of profit, let's get out, or maybe the share price is dropping and it's like, hey, I don't want to lose my entire premium, let's get out while I can, you can sell to close, and that's how you wash that away. So to clarify the premium, a buyer pays the premium, a seller collects a premium. So if you are trying to buy a call option or you're trying to buy a put option, you're going to pay the premium, whatever the premium is, times 100 shares for each contract. If you are selling options, you're going to collect that premium. So that in our initial example, when you paid the $6 or the $600, there was someone on the other end that was collecting that premium. So if your option expired worthless, they get to collect that premium and make that their profit. So we just discussed buying a call option. Next, let's move to buying a put option. So with buying a call option, you are bullish on a stock. You think a stock price is going to go up, and hopefully you'll be able to buy it at a strike price that is below what the price eventually goes to by the time it expires. Now on the flip side, you may be bearish on a stock. Maybe some bad news is on the horizon that you think is going to drop the stock, so you want to bet against it. And this is a way to make money even when stock prices fall. You can buy what is called a put option. Many of the same things apply. You're going to have your bid and ask that you're going to see on the option chain. You're going to have a premium that you're going to have to pay if you are buying an option contract, whether it's buying a call or buying a put, and you're going to have expiration and strike prices. So the main difference, besides being bearish on a stock when talking about puts versus calls, is if you recall a call option, if the stock price went above your strike price, you got to buy the shares at your strike price. But with a put option, your agreement with the person that's selling the option contract is that you get to sell the shares at an agreed upon price. So let's look at our example of Apple again. We're still looking at the January 28th expiration date. The stock currently trades roughly, we'll say, at 175, but we think there's some bad news on the horizon. The iPhone sales aren't as good. Maybe the upgrade isn't going to be as good as we think. So we think shares are going to fall here in the next couple of months. So we are going to buy a put option at the $165 strike price. So if we look at the option chain here, you can see that the highest someone's willing to pay for that contract right now is $4.30. But any of the people selling it right now, the most or the least amount they're willing to take is $4.70. So let's say they meet in the middle somewhere around $4.50. So to buy this put option at the $165 strike price, we're going to have to pay $4.50 per contract, which equates to $450 because one option contract equates to 100 shares. Okay, so let's say by the expiration date, shares of Apple fall to $150 and you own this put option. What this does for you is it allows you to trade shares of Apple, sell 100 shares per contract at the agreed upon strike price. So what you could do, you don't even need to own the shares right now. At expiration date, you would buy at the market price. So you would buy 100 shares at $150 and turn around and sell them at your strike price of $165. So you were able to capture that $15 per share gain immediately right then and there because you owned a put option. You never needed to own shares of Apple to make this trade. All you had to do was pay a premium, and if it worked out in your favor, you would buy the shares at a lower price and sell them immediately at your put strike price. So when it comes to buying options, remember call options are bullish. You think a stock price is going to go up. And buying put options is more of a bearish viewpoint, at least in a near term or by the expiration date that you choose. Now let's turn around and discuss the selling side of options. So again, we still are going to be dealing with calls and puts, but instead of buying calls or buying puts, we're going to be selling calls and selling puts. So when it comes to selling options, or otherwise you may hear it called writing option contracts, you will be doing this and collecting those premiums that we've been talking about. So on the buy side, whether it's calls or puts, we've been paying a premium, but now we will be the ones collecting those premiums. And when we have an agreed upon strike price, expiration date, and someone actually buys our contract, those premiums are debited into your account immediately and they are yours to keep regardless of what happens with the option contract. So let's start with selling a call option. And before we go too far, if you are enjoying this content and you look forward to more videos on options trading and different strategies that I use personally, head down there and hit that subscribe button so you are notified anytime we drop new videos. So let's use the same example as we saw above. We're going to continue to use the January 28th expiration date, and we're going to look at that same $180 call option, except this time we will be on the selling side. So we will be selling that call option for $6 or $600 per contract. As the seller, you are likely looking for the stock price to stay below the strike price, at least until the expiration date, so that your gain is the premium collected. Remember, if it goes above the strike price, then that means that we have to sell our options at that agreed upon price. So selling options is where things can get a little dicey or a little more risky if not done properly. Because remember, with this call option that we own, if the stock price goes above our strike price, we are required to sell 100 shares at that current strike price that we had. So we have the $180 strike price. If shares go to $200 and we don't own any shares of Apple right now, we need to go out to market, buy 100 shares at $200 and sell them for $180. So you can see the big net loss you would have immediately if you do not have the collateral of the underlying asset for the option contract. But there's a better way to do this, and that is where you may have heard of the covered call. What a covered call is we do this same exchange, we do this same option contract, so the $180 strike price, but let's say we actually already own the 100 shares of Apple that we had bought weeks, months, years ago in our portfolio. So if this option contract comes to fruition, shares go to 200, we are just handing our shares over. We don't have to go out and buy them. So that's a little bit safer way to do option selling. So for me, when I'm selling options, especially call options, I'm going to most likely 99% of the time always do a covered call because I don't want to go out there and have to buy 100 shares of Apple at $200. You're going to be paying $20,000 right then and there, and you're only going to get $18,000 for them. So already in the hole, $2,000. Okay, so now let's sell a put option. This is one of my favorite ways to play options. And I'm gonna always do this for stocks and only for stocks that I don't mind holding, at least for the mid to long term. And again, since I'm selling option contracts, once we have an agreed upon strike, an agreed upon expiration, and a premium, I'm gonna collect that premium immediately from the option buyer. So selling a put option, again, we're going to be looking here at Apple, means that you may have the obligation to buy the underlying stock at the agreed upon price, otherwise known as the strike price. So this is what I mentioned at the beginning of my video, when you can kind of build your own buy the dip opportunity. So right now, shares of Apple are trading around 175. Well, in terms of that valuation, it's a little high for me, and I would rather buy shares around the, say, 160 mark. Wouldn't we all like to buy shares a little bit lower? Well, this is a way to potentially do exactly that. So if I sell the $165 strike with an expiration of January 28th, I'm going to collect that $4.50 premium, or $450 premium that I have. And I'm going to do this whether I own the shares or don't own the shares. With selling puts, it's a little bit different because I don't mind owning these shares. I want to buy these shares at a lower price. I don't want to pay the 175, but I would be comfortable paying for 165. Now here's the scenario. So I'll collect my premium, and if shares fall to, say, that 150 mark, well, if I would have just been patient and had my crystal ball or a magic 8-ball and would have known that shares were going to drop from 175 to 150, well, I would have never have done the option because I would have just bought at 150. But since my magic 8-ball doesn't work anymore, I decided to sell a put option at the 165 strike, which means if those shares fall to 150, I need to buy them at the 165 strike. Now, when I wrote it, I didn't have a problem buying at that valuation. So I'm happy with that, even though I'm down $15 per share. Long term, I know that those shares are going to be worth more, hopefully. But at the same time, I didn't buy at the 175 mark. I got to create my own by the dip in a sense. So let's review that real quick. So with buying call options, you are going to be hoping the stock price goes above the agreed upon strike price, because you get to buy shares at the strike price even though shares are above the strike price. When we bought the put option, you are looking for shares to fall below the strike price, because if shares fall below the strike price, you get to sell them at a higher price, earning your gain. So with selling options, it's a little bit different. We have the strike price, we're going to receive the premium. So with a call option, we need to sell at that strike price if it goes above and beyond. With a put option, we need to buy at the strike price. Of course, if the actual underlying stock goes below. And again, let me reiterate, when it comes to selling stock options, make sure that you have the underlying collateral. Remember when we talked about selling covered calls, that means you already own the 100 shares. And if you have to sell them, you don't have to go and buy at a high market and sell them at a lower strike price. You already own the shares, so you're simply just handing them over to the person that bought the option contract. On the flip side, when selling put options, if you need to go out and buy the shares, so I sold the $165 put option and shares of Apple fell to 150, I need to go out and buy 100 shares at 165. So you need to be able to have that cash on hand to do this option contract. So the goal here is very similar to is if you were to own the underlying shares of Apple. You would like to buy low and sell high, or sell high and buy low. That's where the gain is made, in the premium. And most often, when you are selling calls and puts, many of these options go worthless so that you are just sitting there. You could see how I do this on a weekly and monthly basis. I'm just collecting premiums. But the key is to do it in stocks that you like, stocks that you would not mind owning if something goes eerie and falls below your strike price where you have to buy 100 shares. Okay, so hopefully you were able to take away something from this video, whether it's key terms or having a better understanding of what options investing is. We talked about calls and puts and buying and selling. We talked about what a strike price is. That's the agreed upon price, which is going to help everything flow behind it, whether we have to buy shares or sell shares. It's all based on the agreed upon strike price. We talked about options having an expiration date. That's the second term that we talked about. Options expire, which adds a little bit of risk. You can have options that expire on this coming Friday. You can have options that expire next Friday or next month or even next year and 2 years beyond that. The third term that we discussed was premium, and this is where a lot of money that can be made. People are out there just collecting premiums on a monthly and weekly basis with options. But the key here, and this is what I want you to really take away, is if you play with options at all, always do it with stocks that you would not mind owning on your own. I always do it with stocks that I don't mind owning on my own. So I first do my due diligence on stocks that I like, and you can create your own buy the dip opportunity by selling put options in particular stocks that you like. So hopefully you enjoyed the video, and if you did, please again give us a big thumbs up and consider subscribing, as we will continue to build on these videos moving forward with more in-depth knowledge and different strategies on how you can utilize options trading in your portfolio. We will talk about more about the covered call strategy and the cash secured put strategy that I use on a monthly and weekly basis. And also take advantage of the limited time M1 Finance down in the link below, you can get yourself $50 free for opening a new account and funding it within 2 weeks with $100. And also check out BlockFi down below as well. And with that being said, I hope you enjoyed the video, and in the comments section down below, let me know what you thought of the video and what your experience is with options. Is it something that you use ever, or is it something that maybe you use on a weekly and monthly basis like I do as well? Thank you all again for watching, and we will see you in the next video. Take care.